recording. And also let me make sure that people on Zoom can hear me. So please write in the chat if you can. Yes, okay, perfect. Thank you. I was also told that it was difficult in the previous session for students on Zoom to hear what other students in class were saying. So, if you cannot hear when other students speak, just let me know in the chat and I'll try to work this out. Okay, so today we have quite a lot on our plate and we managed to finish it with the first group. So we should also get there with the second group. So what we're going to do today is that we're going to try to understand this yield curve, this object that we talked about before, why rates at different maturities are different and what can this mean. Before, what we did is essentially to build this object, this yield curve, we just said, okay, let's look at the prices of the bonds in the market. From these prices, we can infer the rates, and we just build the yield curve, but we didn't really think about why the yield curve had a specific shape. So there are, two periods that I will talk about. The first one I'm going to spend much less time on, which is the preferred habitat hypothesis, and we're going to focus this first part of the lecture on the expectation hypothesis. So to explain the preferred habitat hypothesis, let's go back to this picture of the yield curve that I showed you before. Right? So the basic assumption of this hypothesis is that there's some kind of market segmentation. Right? What it means that different investors are investing in different securities, and here in particular, different types of investors are investing at different maturities. Right? So to fix ID, you can think of at the long end of the yield curve. So for long-term bond, you're going to have, for example, pension funds, right? At the short end of the yield curve, you're going to have other players, and one of them is money market funds. So money market funds, what they are doing essentially is that they are taking the excess cash from corporates, so firms that can hold excess cash. These firms could just keep it as cash, but no, why not earn an extra return on that cash, right? So they would park this money in money market funds, and this money market fund, they will typically invest in very short-term assets, right? Actually, some of these money market funds have limitations on the type of asset that can invest in, right? And maturity is one of the important limitations. So if you think about pension fund, why does it make sense that pension fund invest in long-term assets? So what is it about the business model of pension funds that make long-term assets a good asset? We're very few people today in the classroom, so it depends on you. Yes?
Yeah, well, they need to pay out coupons or pension fees to their customers over a long period of time. So it makes sense to have an investment there.
Yeah, exactly. So first, before I comment on your answer, can people on Zoom hear what has just been said? Was it loud enough? Yes, okay, perfect. Yeah, exactly. So the important part about your statement is that they have to make payments over long time horizons, right? So pension funds, what are their liabilities? Where they have to make payment to pensioners at some point in time, right? But typically, really later down the road. If you start to invest in a pension fund, the pension fund will have to make payment to you 40 years from now, 45 years from now. Who knows when you're going to be able to retire, right? So the idea is that they are very long-term liabilities, so they should invest in long-term assets, right? Same goes for money market funds. Their liabilities are very short-term. Why? Because the firms that invest in money market funds, they want to be sure that they can cash out at any time without taking any price discount, right? So you need the assets on the securities on the asset side of the money market funds to be short-term and liquid, such that they can meet the short-term liabilities, right? So it all makes sense. If you have long-term liabilities, you invest in long-term assets. We're going to see later on in two classes, actually, that there is a deeper reason why you might want to do that, which has to do with interest rate risk, right? But for now, just think about, I have long-term liabilities, I tend to have long-term assets. So segmentation tells you that, well, you have different players at different ends of the yield curve. And basically what determines the rate is supply and demand, right? If there's a lot of supply of long-term government bonds and not a lot of demand from pension funds, the price will be low and then the interest rate will be high, right? That's the idea. But what's kind of frustrating about this preferred habitat hypothesis is that there's no relationship necessarily between the short-term rates and the long-term rates. Right? And the question we're asking ourselves is if the long-term rate, for example, is really like way too big compared to the short-term rate, is there not a way, sorry, to arbitrage away these differences? So segmentation hypothesis tells you, just supply and demand. There's not necessarily a relationship between short-term rate and long-term rate. Now we're going to see another theory, which is called the expectation hypothesis, that at least tries to connect the long-term rate and the short-term rate. So let me go back there. So what I said, with the slide of the yield curve is essentially what's written here. So what about the expectation hypothesis? So let's start with, a question. We have two rates. We have the 1-year rate, which is currently 0%, right? So which means that if you lend to the government between today and 1 year, you get 0%. There's the 5-year rate, which is 1%, which means that if you invest for 5 years, every year you get 1%. Now that sounds great, right? Because you think, okay, I'm going to invest for 5 years. So, I'm going to take $1 and put it to work in this 5-year investment. How much do I get by the end? I get this amount, right? So this is for my asset side. Now, of course, I have to finance this thing, right? So this $1 that I put in the 5-year investment needs to come from somewhere, right? So you might think, why don't I borrow over 1 year? After 1 year, I borrow again, and again until the end, right? How much do I have to repay at the end? Well, I have to repay the initial $1 that I put in. Now, as you can see, there's a question in this slide, which is what is problematic with this argument, right? Here it sounds like, yes, you can make money, that there's no problem just because the long-term rate is higher than the short-term rate. What is problematic with this argument? Maybe I'm waiting for somebody else, but you cannot just rely on one person. Okay, go for it.
Well, I think if we have only a 0% rate on the first year, then we need to have this rate in the other time period then at some point.
Exactly. So here, the implicit assumption is that the period 4, 5. So that we know for sure. The rate between then 1 year is 0%, right? But nothing tells you that this rate is going to stay at 0%, right? The rate that's going to apply between year 1 and year 2, you don't know it today, right? You have to wait in year 1. In year 1, you're going to look at the price of a 1-year bond, and the price of a 1-year bond is going to tell you the 1-year rate, right? So what's wrong about this argument is that you're implicitly assuming that this 0% 1-year rate will stay the same over the next 5 years, right? That's why we initially claimed that you will end up with some money. And just to tell you that it's not just abstract, if you think about a bank, what does a bank do? A bank takes short-term liabilities, so it borrows short-term from us, for example, by taking in deposits, or also in the wholesale market, right? By borrowing short-term from other banks or from other market institutions. What they do on the asset side, well, they typically lend long-term, mortgages, corporate loans. That's what they do, right? So effectively, you can think about banks as, yeah, they get a higher interest rate because they lend long-term, but they also face a risk. They face a risk that the current short-term rate will not stay, in this case, at 0%. Right? You can think about the fact that the bank gets a higher interest rate on assets as opposed to liabilities as some kind of compensation for the risk that the short-term rate will eventually increase. Right? And in fact, we have one theory, which is the expectation hypothesis, that tells you, well, if that's the case, if the 5-year rate is higher than the 1-year rate, it must be that the 1-year rate will increase in the future. Right? That's what this expectation is telling you. So to be a bit more formal and not rely only on this example, we're going to introduce some notation. We're going to think about two investments, right? So the investment horizon is here always going to be big T. We start from period T, which is today, and we're going to say, okay, I can invest long-term. If I invest long-term, I'm getting this interest. I can also invest short-term, right? Between period T and period tau, get this interest. And then I'm going to reinvest short-term again and get that interest. As we said, what's the issue here is that, well, this rate, we don't know. Now, the expectation hypothesis, as the name says, will say, well, at least we can say something about the expected value of this rate, right? There should be a sense in which these two strategies, investing long-term and investing short-term, are connected. So what we're going to do now is that we're going to go through the simple version of the expectation hypothesis. That's the one that may be familiar to most of you. And then we're going to spice things up a bit, right? But at least it's important to understand what happens in the simple version. So what we're going to say is that we're going to say, well, it should be equivalent in some sense to invest long-term and short-term. So suppose that I invest long-term, I invest $1 today and I cash out in the last period T, right? Let me remind you the timeline here. Today, we call tau this interim period and big T the final period. Okay. If I go long-term, what is the interest rate that I get? Well, simply the interest rate between period T and period big T, right? Here, I use the continuous compounding convention because it's simpler, but if you use annual compounding, the expression will be the power of T minus T, right? So this is just the continuous compounding convention equivalent of that. Now, suppose you do it short term, right? If you do it short term, you put $1 to work. How much do you get by date tau? Well, you get the interest rate on your dollar, so you get exponential RT tau times tau minus T. Okay, you get that. Now you're going to reinvest that dollar, right? You get this, and you're going to reinvest, and how much you get is given by this, right? Here, we're taking a shortcut. We say, okay, what is the interest rate you're going to get? You're going to get the expected value of the interest rate. We take an expected value because we don't know this rate for sure. Now, the next step, and that's where it's very easy, we say, okay, that should be equivalent. So we're going to equalize these two here. So what we get at the end, there's just some algebra, it's not very complicated. We get that, the long-term rate, this one, is a weighted average of the short-term rate that we know today, and the expected value of the short-term rate between period tau and period T. Now, if you want to remember this expression, you say, okay, there's all this tau, this T, this big T, it's complicated. Just think about, a very simple example with 3 dates. And what it tells you is that the long-term rate, the 2-year rate, is half the 1-year rate today, plus half expected value of the 1-year rate tomorrow. Okay. So what you see on the slide is nothing else than a slightly more complicated version where instead of having 0, 1, 2, we have little t, tau, and big T, but this is the same idea. Now, if you put that in the example that we showed before with the 5-year rate and the 1-year rate, what you get is the following equation. And here, sorry, there's just a small typo, as you can imagine. R05 is equal to that, right? So, yeah, just the equal sign that is missing. So remember what we said? We said that this rate is 1%. And here I just wrote this relationship a bit differently, right? Instead of having one interim date, which is just date tau here, I have 4 interim dates, right? 1, 2, 3, 4. But the idea is the same. It says that the long-term rate is a weighted average of the current short-term rate, right? And all these other 1-year rates. So what does it say? It says that, well, if the long-term rates, the 5-year rate is higher than the short-term rates, it must be that the 1-year rates will increase in the future, right? They're going to fill this gap, if you want, right, between the long-term rate and the short-term rate. So in our example, what does it mean? It means that, I was thinking, well, I can borrow at 0% and then earn 1% on my asset side, right? Now, what the expression hypothesis is telling you is that in the future, the rate at which you borrow is going to increase, and that will eat up exactly your profit on the asset side, right? That will eat up exactly this 1%. Okay. Now, what we're going to do now is that we say, okay, we have a relationship, right? This is something we can test in the data, right? So we're not actually going to do it now, but we're going to see what people have found when they tested this relationship. So to do this, we can rewrite this equation, right? And here I just want to show you the step to get from this expression on the slide to the expression on the next slide, right? There's nothing very complicated, but just to be sure. So first, what we're going to do is that for the interim date tau, we're going to take date t plus 1, right? So think about next year or next month. Think about t and t plus 1 very close, and big T pretty far away from little t. Okay, so let's rewrite this expression here. So we have RT of t equal to what is equal, now we get 1 because tau is t plus 1 minus t is equal to 1 minus t RT So just here we get t minus plus 1, t minus t. And we get the expected value. I'm not putting the little t on the expected value, but we understand that, sorry, it's the expected value from the point of view of that little t. Here we have rt plus 1. So here I did nothing except replacing tau by t plus 1 in this expression. Okay. Now what I'm going to do is that I'm going to multiply, the left-hand side by t minus big T minus t divided by big T minus t. This is just multiplying by 1, so I'm not doing anything actually here. Okay. Now I'm going to rewrite this left-hand side as follows. Right? I'm going to say that this is t minus t plus 1 plus t. But now, I have to add this one. Okay. And the right-hand side is exactly the same, right? So that's the right-hand side. My right-hand side is exactly the same. Okay. Now, if I rearrange this expression here, right? What I'm going to do is that I'm going to get that 1 over t minus t. So it's a bit cumbersome, but this is just to make sure that everybody knows how we go from one to the next. Okay. So you see that there are two terms that are multiplying 1 over big T minus t. I'm just putting them on the same side. I'm going to do the same thing with the two terms that are multiplied by big T minus t plus 1 over t minus t. Here I get big T minus plus 1, t minus t. And that's multiplied by expectation. Okay, so this is just the steps to go from the expression I show you to this expression on the slide, right? So this one here. Except that there's one more simplification that has been made, but basically this is the idea. Okay, so it's not very important that you can do it, but just when you go back to the slide and wonder, okay, how do we get from here to there? This is the way to get there. Okay, so again, what does this relationship tell us? It tells us that if the long-term rate is higher than the short-term rate, which is the slope here, so if the slope is positive of the yield curve, right? This is long-term and short-term. If that's positive, it means that the yield curve is like this, upward sloping. Well, it means that the interest rate should increase, right? So just to be clear, these two rates here, they do not have the exact same maturity, right? So this one is t minus 1, this one is big T minus t, right? But the idea is that, if t and t plus 1 are sufficiently close and t is far away, effectively you're comparing, let's say, a 20-year rate and a 19-year rate, but we can say that they are almost the same, right? So we're going to say that the two rates on the left-hand side are for the same maturity, right? This is what is explained here. Okay, so what it tells you is that if you take this long-term rate, the RT of t, if the yield curve has a positive slope, this long-term rate should increase, right? On expectation, that's what you should observe. And it's just another way to state this expectation hypothesis. As I said, people have been looking at that in the data, right? So does this thing actually hold? So suppose you want to test this, right? So you're going to say, well, when the slope is positive, is this term also positive, right? So that's what you're going to try to see. Now, of course, there's one thing that you cannot measure on the left-hand side, which is you cannot know what is the expectation today of the rate in the future, right? So this is not something that you can see. There are ways to try to infer that, but this is not something you can directly see. But the idea, that will do is that yes, there can be a period where maybe the slope was positive, but then the rates went down. But on average, if the slope is positive, the rate should go up, right? This is what this thing is telling you. The expectation should go up, so it means that on average, it should go up. So if you look at this relationship over many, many periods, you should get the same thing as the expected statement, right? If the slope is positive, most of the time you should see that the interest rate go up. So Campbell and Shiller, which are two very famous people, and these are household names in finance, and you will probably meet them in other courses in the master if you have not done before already. They tested this relationship, right? Other people have done it, but their test is one of the most famous. So they say, okay, we're going to test this relationship, which means that we're going to run on the left-hand side the increase in the rate, right, which is the equivalent of what we have in the relationship. And on the right-hand side, we're going to have, our slope here. Yeah, and we're going to try to measure to estimate the coefficient alpha, but mostly beta. So again, simple question: if the expectation hypothesis is true, which value of beta should we expect, right? So which value of beta should we find via this estimation? And you can also answer in the chat, although I'm not very good at monitoring the chat, but you can try. Question I'm asking you is that, if the thing that is at the top is true, which is the theory, what should we expect to find in data when we measure this beta? Yes?
Should be positive.
Positive? Can you say more than positive?
Because it means that it should be a positive relationship, and the longer the maturity, the higher the interest rate, if the coefficient is positive for statistical reason.
So that's true, but what I'm saying is that, okay, see also in the chat, yeah, someone says in the chat, so positive is perfectly right, that's what we should expect, but we should even expect beta to be 1, right? Because if that's true, the relationship at the top, you see that here, the beta here in the sense is equal to 1, right? So that's what you should see. So I'm saying that's what we should expect. When you test a theory in the data, and the theory sheet tells you the coefficient is 1. If you actually find 1 in the data, that's very good news for your theory, right? But that barely ever happens. What you hope to get right at least is the sign of the relationship, right? So just as you were saying, we will hope that this coefficient is positive. Now, bad news, what you find in the data is that this beta hat, the estimated value of beta, is negative for most maturities, in fact, right? So it runs counter to this expectation hypothesis. The expectation hypothesis tells you positive slope of the yield curve. It means that interest rates should go up. Well, what this relationship tells you is that on average, they actually go down. Right? So that's the thing that is surprising. And there are many tests about this relationship. And they all find consistently that this doesn't go in the way that the theory tells us. So there are many things that can be wrong with this thing, right? So first it's a simplified setup. So what we're going to try to do now is that we're going to see, okay, are there some basic problems with the assumptions that we made? And if there are problems, can we correct these problems to try to find a better version of this expectation hypothesis, to try to get a better understanding of the relationship between long-term rates and short-term rates? Okay. So, usually it's not a good idea to have things that are wrong on a slide, but here it's on purpose. What we're doing on this slide is to try to understand why the relationship that we wrote before were actually not correct. I'm going to argue that, to write the naive version of the expectation hypothesis is to argue, is the same thing as to argue that, two strategies are equivalent, right? And of course, what we're going to claim is that they are not, or at least if we want to claim that they're equivalent, we should adjust for something. Now, I'm going to say that, there are two things you can do with a long-term bond, right? So here I'm talking about a bond that I buy in period little t, and that matures in period big T. And I'm just going to set the face value equal to 1 to simplify. So first thing you could do is that you buy the bond that costs you PT of big T, right? And then you wait until period big T and you get your cash flow of 1, right? You're going to get this. It's a government bond, doesn't default, you're going to get 1. The second strategy, you buy the bond, so you pay the same price, presumably, but you're going to sell this bond in period tau, right? And this price in period tau is in red to highlight the fact that the price at which you're going to sell this bond is risky, right? It's nothing else than saying, if you buy a stock today, you don't know at which price you're going to sell it in the future, right? Or if you know that, it means that you have a very good model and you should probably trade on that model. In bonds, if you buy the bond and hold it until maturity, you know what you're going to get. But if you sell it before maturity, well, you don't know what the price is going to be. The price will depend on what the interest rate will be at that time. Now, what we did, as I said, is that naively we said, okay, these two things should be equal, right? So I write the price of my long-term bond here. The first relationship is fine, right? This is just the way we define the long-term rate. We said that the long-term rate is the yield to maturity of a long-term bond, right? If this bond is a zero coupon bond, that's perfectly fine. Compute the yield to maturity of the zero coupon bond, and we find the discount rate for that maturity. As an aside, you know, if it's not a zero coupon bond, you cannot make that claim, right? I just want to be clear. If you have a bond that pays coupon, let's say a 5-year bond, and you compute the yield to maturity, that's not the discount rate for maturity 5 years, right? Why? Because this coupon pays, this bond pays coupon in the middle, and you're also loading on the discount rate for other maturities, right? So the yield to maturity of a zero coupon bond is the discount rate for that maturity, but that doesn't work for a coupon paying bond. Okay, so the first one is fine. Now the problem is that, you know, what we wrote effectively is that we wrote that the price of the bond is also equal to the second thing here. Right? Now we said, well, you know, at date tau, we're going to get in expectation this cash flow here. And we just discount this cash flow at the risk-free rate, right? The rate that the treasury will command between period T and period tau. So why is that wrong? Why is it a mistake? Because this cash flow is risky. As I said, you know, it's in red, it's risky. It means that you don't know how much you're going to get, right? So if you have a risky cash flow, you cannot discount it at the risk-free rate. We're going to see in the next slide, how do you adjust for that? So there's a second mistake that is a bit subtle, but I want to explain it because it will have an impact on the relationship that I will show you. Now, what is this expected price here? You can write it as, so this is the exponential of R tau with T. Okay, so that's fine, you can write this. Now, what was not fine and what we implicitly did is that we said this is equal to that. Right? What we said the expectation of this thing is equal to the exponential of the expectation. Right? So what we, you know, we can see a more general version of this mistake. You know, what we did is that we said, okay, there's a function f. Here in this case, the function is exponential of minus x. Right? This is the function of the interest rate that gives you the price. Of course, you have the t minus t, but this is not what would matter. And what we say essentially is that the expectation of f of x is equal to f of. So why is this wrong? Why cannot I write this equality? Do this. That's a pure math thing, you know, like if you either know it or you don't. But there are functions for which you can actually write that, you know, it has certain properties, but I'm arguing that for this function you cannot. Anyone? Maybe in the chat? Okay, the reason is that, you know, this would be an equality only if the function is linear, right? Now, this function is not linear. If you try to plot it, x here, one would look like this, right? What it is effectively is a convex function. And I don't know if some of you have heard about the Jensen inequality, right? If you have a convex function like this one, this is what you get, right? So you get an inequality in that direction. If the function was concave, you would get the inequality would be reverted, right? Now, you know, you might say, okay, what is this Jensen thing? You know, I never heard about this. I'm sure there's at least one version of this that you heard about, which is related to the concept of variance, right? If I write that the expectation of the square of a variable is above the square of that expectation, maybe that sounds a bit more familiar. Right? This has to be, because the difference between the two is simply the variance of a random variable. Right? And I'm sure you talked about variance in the previous class at least. Right? But why do we have this relationship? Well, because the function that to x associate x squared is convex. Right? It's convex, we can apply Jensen inequality, and that's why we have this result. Okay. Here, same thing, the function, you know, that maps the interest rate into the price is convex. So we get this relationship, right? So why am I, you know, talking about all this? This is not only for the math nerds among you. This is also because it's going to impact the formula that I will show you on the next slide, right? So we're going to come back to this term of convexity. Okay. So now what's our mission before the break? We know that we did something wrong with the naive version of the expectation hypothesis. we're going to try to augment this expectation hypothesis to take into account this risk. Basically, we want to account for the fact that, you know, if I do the resale strategy, so strategy number 2 here, this one, I'm effectively going to get a risky cash flow. So I cannot discount this risky cash flow at the risk-free rate. Okay, so that's probably the most, you know, notation heavy slide of the course. So, you know, like don't worry, there's a lot there, but, you know, we're going to pack it. And at the end of the day, you know, what matters for me is that, you know, you get the intuition rather than the math. So the first step is that we're going to say, well, the first strategy, so this is what I call S1 before. You buy your bond today, you hold it until maturity. That's how we price this bond. This is almost by definition, you know, the long-term rate RT of T, if it's a zero coupon bond, this is the yield to maturity of that bond, right? So that's almost, this first relationship is almost by definition. Now, how do we adjust the second strategy, what I call S2 before, when you buy the bond at date T and you resell it at this intermediate date tau, right? So again, you know, just remind you T and DT. Now, what we do here is that, yes, we're going to take the expected value that we're going to get here, but we're not going to discount it at the risk-free rate RT of tau. We're going to add a risk premium. Right? Why do we do at the risk premium? Simply because the cash flow we're going to get is risky. Now, from here to there, we didn't do anything special, right? We just wrote what the price is, right? And we keep everything in expectation, right? So this is totally legit. This is not related to the mistake I talked about before. Okay, so now we want to compute this expectation to have a closed form solution. Right? In general, if you don't make assumption, this is difficult, right? The rate that will apply, you know, here, which is R tau of big T, you don't know it today, right? So you can think about it. This is a random variable from the point of view of today. So basically, we need to make assumption about the distribution of this random variable. So what do we do in finance when we need to make assumption about distribution of a variable? We say it's normally distributed, right? Does it mean it's normally distributed? Yeah, probably not. You know, if you look at the pattern of interest rates, it's highly unlikely that you're going to get a nice, you know, M-shaped curve, right? Recently, there's even, you know, a very good reason for why you don't get this nice pattern, because the rates have been compressed at 0, right? So we'll have a lot of observation at 0, and it will look nothing like, you know, this nice bell-shaped curve of normal distribution. So you can tell me where, you know, we're trying to fix this thing, and now you're putting an assumption that is kind of, you know, weird. So that's fair. What I'm saying here is that we make this assumption because it's going to simplify, you know, the math. At least what we get right compared to the previous method is that before we did as if there was no risk in this interest rate. Now at least we account for the risk, right? Whether the distribution is right or wrong, well, this is, you know, for you to go to the data and to find a better distribution of this interest rate. Right? Now, because this distribution, normal distribution, is so workable, we can obtain this expression here, right? And the red term here, you know, matches the red term there. And there we see what we obtain is that something that depends on the expectation of the rate. So that's just as before. But we're also going to have a volatility term. Okay. So that's the part that accounts for the risk. Two parts, you know, like change compared to the previous, you know, version. There is this risk premium here. And there is this volatility term, right? Now, okay, it would be too painful for me to do it in class, you know, to just take logs on this relationship and to rearrange everything. You know, you can check it for yourself if you want. You know, I think after 5 years of teaching these slides, there should not be any mistake, right? But, you know, we never know. If you find some mistake there, just let me know. I don't think there's a mistake. But, you know, feel free to check it for yourself and you should get, you know, to the same outcome. Okay. What's interesting about this? Well, you see that the long-term rate now is much more complicated, right? If you forget about the two last term here, well, we're back to what I call the naive version of this expectation hypothesis, right? In that naive version, the only thing that could happen is that if, you know, if the yield curve has a positive slope, it must mean that the rate will increase, right? That's the only thing that could happen. Now, what you see here is, you know, you have two more terms, so, you know, there are two other things that could change, right? Now, what's the idea? If we focus on the risk premium term, for example, well, if the yield curve has a positive slope, before the only thing you could say is that, well, it must be that the interest rate will increase. That was your only way out. So you can say, well, this might be because there is high risk premium, right? investors maybe are requiring a risk premium to hold long-term bonds as opposed to short-term bonds, right? And we're going to see that, the reason why this risk premium shows up in this relationship can be rationalized by the riskiness of long-term bond versus short-term bond. We're going to do that in the next slide. In a sense, if you think about it like this, you might say, well, you're talking about risk, okay, long-term bonds are more risky than short-term bonds. That's fine, I'm going to take this. So I kind of understand that this risk premium term here will be positively related to the long-term rate, right? And that's, we're going to go to the intuition on the next slide. Now, what might be more surprising at first is that, well, wait a minute, there's another term that is related to risk, which is, this one here, related to the volatility. Here you have the square of the volatility, so that's the variance. And that terms actually decrease the long-term rate, right? That might be surprising. And that, I would argue, is related to the effect that I call convexity, right? So what I'm going to do on the next slide, and we're going to do that before we take a break. I'm going a bit faster than in the first group, but yeah, I guess that's fine. I'm going to explain this effect first, right? And then I'm going to try to explain this second effect, right? Why do I say I'm going to try to explain? Not because I don't understand it myself, that part is fine, but simply for two reasons. Because I think it's not super important that you really understand what's going on, because we don't have all the tools, we're not equipped with all the tools to actually understand it. I'm going to try to give you some kind of high-level intuition. If you want to know more about this, there are some parts about this in the Veronesi book, so you can check there if you're interested. I don't think his explanation is so great anyway, but if you want to know more about this part, you can look at this. But the bottom line is that to really understand this convexity effect, we need more complicated models than the one we have here, right? What really matters for me is that you understand the part that is related to the risk premium, so this thing here, right? If you also understand the part about convexity, that's good for you, perfect, but this is not something I will ask a question about in the exam. Later on in the course, we will see that this convexity shows up again. I used to teach convexity in this course, but at the end of the day, I think it's really like a fixed income trader thing. If you don't do fixed income trading later on, I'm not sure this is going to be super useful, right? I mean, you can always sound smart in the discussion, but if you have too many discussions about fixed income, maybe this is not a super good sign. Okay. So what I'm going to do is that go through this first term, the risk premium term, and try to explain why it shows up. Why this risk premium term increased the long-term rate as opposed to the short-term rate. All right. Again, if you have any question at any point, feel free to stop me also in the chat. As I said, I'm trying to monitor the chat. Okay, so what we said is that the long-term rate increased with the risk premium, right? So the way to rationalize this now is that we're going to think about somebody who has a short-term investment horizon. Okay, so you invest at T, and tau is the date when you want to cash out, right? So this is my short-term investment horizon. Again, we're going to compare a safe strategy with a risky strategy. So you might tell me, well, this is yet another version of the same thing. Yes, this is exactly why I'm doing it, to try to get the intuition in a different way. And here, instead of just deriving the math, we're going to try to understand why this risk premium plays a role. Okay. So first, you can do the thing that is riskless, right? So you buy the short-term bond that pays at date tau, right? So the strategy. What are your cash flows? So we start with $1. So 1%. So if you invest $1 at date date T, how much do you get at the end? Well, you get 1 over the price of that bond, right? Which is nothing else than exponential of RT. And tau minus T, right? You just get the safe interest rate between T and tau, right? This is the easy part. And now think about my investment horizon is still tau, but I'm going to invest in the long-term bond, right? So there you already see that there's some kind of mismatch, right? I have a short-term horizon, but I'm investing in a long-term bond. Now, what is going to be my return in expectation? In expectation, I'm going to make this, right? I buy the bond today. In expectation, I'm going to sell it at the price P tau of big T. That price itself is risky, right? It depends on what the interest rate will be between period tau and period T. But I take the expectation of that. Again, here, that return is risky, right? So if you want to compare these two returns, we have to apply the risk premium, right? So the expected return on the risky strategy is equal to the safe return, riskless, right? And you need to add the risk premium, right? Again, you know, if you develop this formula, you're going to get back to the same thing as before, right? But of course, this is on purpose. Okay, now what do we make of this formula? We say, well, suppose the risk premium increase, right? If the risk premium increase, it means that the right-hand side goes up. Now, if the right-hand side goes up, this means that this PT of big T must go down, right? If you want this inequality to work. This equality to work, sorry, it's not an inequality, it's an equality. And you know, PT of big T is simply the inverse of the long-term rate, right? So if PT goes down, it means that the rate increases. Okay, so you know, the way to think about it is that, you know, the long-term bond is more risky, right? If you have the short-term investment horizon, you can invest in a short-term bond that's safe, you know the return. If you invest in a long-term bond, you don't know the return, and so there's a compensation for risk. Another way to think about it is that, you know, if you think about the bank example that I gave you before, right? So the bank is lending long-term at a high rate and is borrowing short-term, right? So for the bank, you can think about it also as, well, this is the risk, the compensation that I get. So the fact that, let's say, the 5-year rate is higher than the 1-year rate is the compensation that I get for the risk that the interest rate might increase in the meantime, right? So these are just two sides of the same coin, right? So whichever intuition works better for you is great, as long as, of course, it's the correct intuition, right? So that's the explanation for why if rho here increase, then long-term rate. Okay. So now let me go to the second application, which is, you know, the one that, as I said, maybe is a bit more difficult to understand, and it is, in fact, which is the effect of the volatility term, right? So the fact that, you know, what I call this convexity term, if the volatility increases, the long-term rate actually goes down, right? So why does it sound weird? Because, you know, well, you just told us that if, you know, something investors care more about risk, they require a higher risk premium, the long-term interest rate will go up, right? Now, why does something that has to do with risk will actually decrease the long-term rate? Okay, so let me, then we're going to have the relationship here that's going to be useful. Okay, so I call it the convexity term for the following reason. Remember that, you know, what I said is that take the expected value today of the price of the bond here tau. I'm just rewriting it. Oh, T minus tau. What I told you is that, you know, this is higher than expectation, exponential of the expectation. And why did I tell you that it was higher? Because if you plot that function, which basically maps the rate into the price, it's convex, right? Convex means simply that it's not linear. How do you know that a convex function is convex? Well, actually, it's very simple. You take 2 points, you draw a line between these 2 points, which I'm going to attempt to do. Okay. And if that line is above the curve, it means that it's convex. If it's below the curve, it means that it's concave, right? So fairly simple to know whether a function is concave or convex. Okay. Now, as you can see, convexity has to do with how much curvature there is in the function, right? So, you know, a linear function has no convexity, right? It's completely linear. And there, the inequality that we have here will actually be an equality. So the more curvature there is, the more, you know, so the bigger this difference will be between this term and that term here. Right? Now, convexity has to do with the curvature, right? So curvature, when you think about curvature, it is linked to the second order derivative, right? So the slope is the first order derivative. If you want to know the slope of a function, you compute the derivative. This is the first order derivative. If you want to know curvature, we compute the second order derivative. Okay. And that's where, like the intuition goes at a high level. So if you think about second order is exactly risk, right? So this is, when you think about second order moment, this is the risk, this is volatility, right? So basically what I'm telling you is that the higher the volatility in the rate, the bigger the difference will be between this term here and that term here. Why? Because convexity will matter more when you have a lot of risk. Okay? Because these two are second order phenomena, right? That's the part that that I know on purpose is not very well defined, but that's the high level intuition. Okay, so now if we go back to the equation that we have here, I'm going to erase a bit, make more space. Suppose volatility increase. What we know is that this will tend to increase this term here, right? So if the rate increases, we tend to increase this rate here. Yeah. Now, if the right-hand side stay constant, what has to happen? Well, it means that denominator should increase as well, right? The price of the long-term bond. Now, again, the price of the long-term bond is the inverse of the long-term rate, right? It's negatively related. So let's work to this. Volatility increase, the convexity will matter more, which means that this term will tend to go up, or at least the difference between this term and that one will go up. The numerator of the right-hand side will go up. So for this to work, PT of big T will have to go up, which is the price of the long-term bond. And that means that the rate decreases, right? So that's why when you go back here, if sigma increases, okay. So again, if you understand what's going on, that's great. If you're interested, you can go to Veronese. There are some, there's maybe like one paragraph about this. I don't think you might necessarily get much more than my explanation, but at least it's written in words, so maybe that's easier to take in. But the bottom line is that this is not something that I will put emphasis on, right? So, I might ask you to use this formula, so that's fine, but I'm not going to bother you with questions like, explain exactly why you have the convexity, why it's going on, play with this, second order derivative. This is not what's going to happen. Actually, we're going to see later that, convexity matters in other contexts, right? But, there used to be one lecture about convexity in this course. I took it away because I think it's too technical and not interesting enough. So again, the one that I really care about, this one, if you also understand this one, that's great, but I would argue this is optional. All right, yeah, we're just a bit late, but we're going to take the break now. And so after the break, we're going to talk about, it's going to be much less technical than this. We're going to take a break a bit from all the equation, and we're going to talk about monetary policy. So let's meet at 1:15. Start again the recording. Yeah. If you see that, I don't start recording either at the first part or second part, just let me know, because I have 2 chances to do it, but if I miss the second chance, then it's over. You cannot record the lecture again. All right. So kind of, some bottom line on this, there was 2 versions of the expectation hypothesis. What we said is that the simple version is, proven wrong in the data, right? So this doesn't work in the data, right? So you should be careful, to base any strategy on the predictions of the yield curve, right? So suppose, that, today the yield curve has a positive slope, right? So which means that the long-term rates are higher than the short-term rates. But you might think, okay, I know that by the expectation hypothesis, this tells me something about the way the rates will move, right? So to make that a bit more precise, you have the final date t, here you have t plus 1, big T. And the assumption that we're making is that, the yield curve, as it's most usual, such that the long-term rate is higher than the short-term rate, right? So that's what. Now, according to the expectation hypothesis, at least the naive version. In the naive version, the only way this can happen is that if we expect the rate tomorrow to increase, right? So that's the only way that can happen according to the simple version of the expectation hypothesis. Now, if you think about this, you say, okay, what does it mean? Today, rates are low compared to what they would be in the future. Right? The other way to say this is that price of bonds are high compared to what they would be in the future. Right? So you might think, okay, I'm just going to short sell bonds today. Right? Now, as we saw, the naive version of the expectation hypothesis doesn't work in the data. So actually, if you see that pattern, if you see this positive slope here, right? It's more the other way around, right? So actually what you should do, according to what you see in the data, is that instead of selling these bonds, you should buy them, right? Because what's actually going to happen in the data is this, right? Interest rate will go down, right? So interest rate will go down. It means that the price of what you own will increase, right? So you should rather do the opposite thing. And what we saw in a sense is that, when you're doing that, what you're effectively capturing is the risk premium, right? The risk premium that we talked about. Effectively, you're capturing the risk premium that corresponds to investors' preference for short-term bonds over long-term bonds, right? Long-term bonds are penalized with this risk premium because if you have a short-term investment horizon, they are more risky, right? So again, this is the basic takeaway from that. In the problem set, you have an exercise that is called expectation hypothesis, and you have one of the questions that is called rolling down the yield curve. And this is a difficult question, so I'm not going to give you the indication for that question, but it's basically based on this kind of risk premium notion from the expectation hypothesis, right? So yeah, I'm not going to say more than that, but hopefully you will see the relationship between this strategy and the expectation hypothesis. I think you should see it to the extent that the question is asked in a big question that is called expectation hypothesis. That makes sense. Okay, so now what I also want to say is that although this naive version of the expectation hypothesis tends to be wrong in the data, this is something that you hear about many times, right? So this is really something that market commentators, journalists are sometimes using implicitly to talk about interest rates. So I'm giving you two examples. So the second one we're going to cover later, right? When we talk about monetary policy here. The first one is, a pattern that, maybe we discussed in the other group, I don't remember, that you see before financial crisis, right? So if we go back to the yield curve slide, oops. What I told you is that, before financial crisis, so, here you see it before the dot-com bubble, before the great financial crisis in 2006, 2007, and before the COVID crisis. And actually, this is the time that this FT quote is referring to, this one here. Then what we see is that, instead of having a nice yield curve with a positive slope, where here you have maturity, and here you have rate, we tend to have a flattening and even sometimes an inversion of the yield curve, which means that this goes up and this goes down, up to the point where actually you could have something flat or even decreasing. Now, what this article is telling you is that, an inversion of this yield curve has preceded every recession of the last half century, right? Now, so what we saw, kind of informally on this graph, turns out to be a pretty good predictor of financial crisis. Okay. Now, how can you explain this, this pattern, if you think about the expectation hypothesis? Okay, so what is the way to explain this pattern through the lens of the expectation hypothesis that we just talked about? And here you can just think about the simple version. That's enough. Waiting to see whether maybe somebody else before. But if nobody else, I will ask you, don't worry. Okay, go ahead.
I had one question.
Okay. Yeah.
Couldn't be also a reason that, for example, money market funds have done a bank run, for example, that many companies are now extracting their money, and therefore they need to sell them the
long-term bonds,
and also the short-term bonds. Then, right?
So you think about a bank run on the money market funds?
Yeah.
And so you propose that this could be a reason for like the difference in the.
No, why then also the interest rates are then increasing for the crisis.
The interests are increasing before the crisis.
Yeah.
So that, you know, as we're going to see, that this combination of several factors. One of them is that monetary policy is typically trying to lean against the wind, which, as we're going to see, means that in times when the economy is doing well, you want to prevent the economy from doing too well, in the sense from overeating. So what you're going to do is that you're going to increase interest rates with the aim, getting tired of tightening credit, right? So that's what you see, this pattern of rates increasing, right? Of course, you know, there's not only monetary policy. In an economy that is doing well, you should expect a lot of credit, the cost of credit to increase. So this is also a kind of a good sign, right? So here I'm talking more about, you know, right before the crisis, this inversion of the yield curve. What it means that short-term rates tend to be lower than, long-term rates tend to be lower than short-term rates. This has implication according to the expectation hypothesis, right? So why is it consistent with flattening of the yield curve being consistent with a crisis coming up? Slope is negative, it means that rates decrease, right? Yeah, good.
So mean an investor had really negative expectation about the long run. And they think that maybe, for example, government bonds require a risk premium in the short term. They think that government could not be able to avoid bankruptcy in the long run. So they have basically they have negative expectation in the long run.
Okay. So yeah. So this is, you know, what I have in mind is related to what you're saying. So basically, I'm even thinking about simpler mechanism, right? So I'm just saying slope is negative. It means that investor expects rates to go down, right? So that's, you know, that's what the naive expectation version is telling us. Now, why, you know, what does it mean to expect lower interest rates? There can be two things. First, in an economy that is not doing well, rates are typically going to be low because, you know, there's not a lot of credit going on. So interest rates are going to be low, right? So that could be a sign, you know, of economic contraction. Now, another thing that's happening, and, you know, that's what also people are thinking, is that, you know, precisely if there's a crisis, we expect the central bank to decrease the interest rates, right? Because what central banks are trying to do is to fight crisis, and you're in a bad time, you decrease the cost of credit so that people have easier access to credit, right? So this, you know, negative slope of the yield curve could mean that people in the fixed income market are pricing in the fact that the central bank will actually decrease the interest rate, right? And so these are the, you know, two of, you know, maybe there are maybe others, but two of the main explanations, that are given for this pattern, right? Now, you know, this might be true before crisis, but, you know, what we know is that on average, you know, if you don't look just at crisis episode, on average, this naive version of expectation hypothesis does not work, right? That is what we did before the test that we did. We saw that on average, if the yield curve has a positive slope, interest rate will decrease instead of increasing according to the theory, right? Theory says positive slope, interest rate increase. Data says positive slope, interest rate decrease, okay?